Hi, welcome to Finance Decoded, the channel where I make finance easy for you. And in this video, I'm going to take a closer look at the topic called time value of money. Time value of money is a very basic concept in finance, intuitively understood by pretty much everybody, I believe. However, it is often misunderstood, and I think it is very useful to take a closer look at it and master some techniques that are connected with the time value of money, such as compounding and discounting. Why is that important? Well, first of all, being the basic technique in finance, using time value of money gives you access to various tools which are used everywhere throughout finance. Okay, so we can mention, for example, assessment of investment projects, techniques like NPV, for example, or internal rate of return. They all relate to the time value of money. All valuation techniques of instruments such as bonds and shares, even companies, they also relate to the time value of money. All right, let's get to work. What is the time value of money? Well, the commonly understood concept is the following. Okay, if this is the timeline, and we assume that on this timeline we denote the moment of now, and assume that an investor has 100 euros in the pocket. If they decide to not to consume this 100 euros, but to give it to somebody else for a certain amount of time, let's say for 1 year, okay, for example, it's going to be a bank deposit. It is quite obvious that after 1 year, the investor can sensibly, reasonably assume to receive more in the future, more in 1 year. Okay, so let's assume that the contract with the bank is such that after 1 year, the investor gets 104 euros per each 100 euro invested. Okay, so obviously this 4 that the investor gains is the effect of the time value of money working in practice. Okay, it's a remuneration or a return for the fact that 1 year has passed. Okay, as simple as it gets, I believe it requires some explanation why the bank is actually willing to pay the investor more. Okay, why do we get interest on deposits? Why we expect to receive a certain return on other investments? Okay, why does money change value over time? Okay, so typically when I ask my students about that, what they mention is the concept of inflation. The term inflation appears a lot in this context. Okay, I mean, inflation has been quite a hot topic in the global economy for the last couple of years after recovering from the COVID pandemic in 2020. So it was widely discussed in the media, and of course, inflation is connected with the time value of money. In fact, it is one of the measures of the time value of money. Okay, inflation is a topic that deserves a separate video. Okay, so expect a new one devoted especially to inflation. For now, I think it is sufficient for us to know that inflation is just a measure of the change of prices in the economy. Okay, so it simply means that if you have this 100 euros right now, you can go to the shops and buy something. After 1 year, you will not be able to buy the same amount of goods and services. Okay, so obviously the higher the inflation, the higher the expectation of investors related to the return of certain investments. Okay, but even if you assume for a moment that inflation equals to 0, so prices are fixed in the economy, they don't change at all, still most of you will probably expect some remuneration for the fact that you invested your money, that you gave your money to the bank, for example, as in our example. Okay, to put it another way, most of you would probably not agree with inflation being 0 to receive the same 100 euros after having invested in a bank deposit for 1 year. Okay, so if despite no inflation we still receive remuneration for the passage of time, what is it actually for? Why do we get this extra return, this extra interest? Well, I think the easiest way to explain that is that, in fact, if you decide to invest 100 euros by giving it to the bank, you give away a certain opportunity that normally comes with the fact of possessing money, with owning money. Okay, namely, if you have money, you can spend it. Okay, you can go and buy. Now, if you take this amount of money, give it to somebody else for some period of time, you no longer have this opportunity, right? So, in fact, time value of money, or the remuneration that comes with the passage of time, is the remuneration for the fact that an investor refrain themselves from consuming. Okay, so from this perspective, knowing that in the time value of money we have both the aspect of remunerating for refraining from consumption, and also we've got the concept of inflation, I think we can introduce two terms that come with the time value of money, namely the so-called nominal rate of return and the so-called real rate of return. Okay, most of rates of return, such as, for example, interest rates on deposits or interest rates on loans or yields of financial instruments that are traded, that are offered in the financial market, are nominal rates. Okay, nominal rates, also sometimes referred to as money rates. Okay, so what does it mean? It means that they do not take into account the loss of the time, the loss of the value of money that stems from inflation. Okay, for example, if we come back to this simple case of a bank deposit, okay, this deposit, while giving the remuneration, the return of 4, okay, for 1 year, okay, in fact, it gives the investor the rate of return of 4%. Okay, it obviously can be calculated as 104 that is received after 1 year minus 100 that was invested initially divided by 100. Okay, we get a 4% annual rate of return. Okay, this rate of return is the nominal rate of return or the money rate of return. Okay, so what it basically means is that the investor gets 4%, and then this 4% has to somehow be adjusted for the increase in the prices or adjusted by inflation. Okay, so if there actually comes any real rate of return, any real return with this instrument, it will depend on inflation. Okay, so the real rate of return, on the other hand, is going to be the rate of return, or the nominal rate of return, adjusted by inflation. Okay, here in this example, it seems pretty obvious that we assumed now that inflation was also 4%. Okay, so you invest for 1 year, you receive 4% nominal rate of return, and then you lose 4% of value because inflation went up. I mean, all the prices in the economy also went up by 4%. Well, your real rate of return would be 0. Okay, so typically if you think about different investments, okay, and you are offered certain rates of return, these are going to be the nominal rates of return or the money rates of return. You will receive this return at the end of the investment in the value of money that the money will have when this investment ends. All right, so the inflation is going, I mean, if inflation is a positive number, and most of the time it is in the economy, it's going to some extent consume your return. Okay, and it's worth remembering that in the economy, most of the rates, like for example yields of bonds, for example, or yields that are made on investments such as investment funds, ETFs, and so on. They are all given to you. They're presented to you as nominal rates. Okay, so on the top of that, you need to adjust for inflation. Okay, so as I said about inflation, I'm going to make a separate video. I think what I've said is enough for this video on the time value of money. Okay, and now going a bit further, I think it is useful to define some basic terms that come with the technique of using time value of money in practice. All right, so in the example of the bank deposit, we had two moments in time. Okay, we had now. Okay, now is simply is usually in finance referred to as time zero, the moment of time zero, which is right now. Okay, so not in the past, not in the future. Okay, and then we've got some moment in time in the future, which comes 1 year from now. Okay, that's a timeline of the investments. Okay, and in finance we refer to the value that we have now. Okay, it was 100 euros in this simple example, as the so-called present value. Okay, and then in the future, after accruing the interest offered by the bank of 4%, okay, annually, the investment will have the value of 104 after 1 year. Okay, from today's perspective, this is a future value. Okay, very often these terms, present value and future value, are abbreviated to PV as present value, okay, or FV, the future value. Okay, so it's quite possible that when you see a document that relates to investment projects, you see PV or FV, it's quite likely that these numbers are going to relate to present value and future value respectively. But of course, what I strongly encourage is that before you actually start analyzing any document, any real documentation, and start interpreting certain numbers, it's always good to look at the explanation of the document, okay? Because PV may stand for present value, but either well, it can stand for something else, like, I don't know, photovoltaic batteries or something like that, okay? And future value, FV, okay? The FV may also relate to, for example, fair value, which is an accounting concept relating to the market value of certain items like assets, for example. Okay, but for now we're going to use PV for present value, FV for future value. Okay, and now what is the technique that can be applied to these two numbers? Okay, so having the present value and knowing the certain rate of return, which is 4% in this case, we can add interest. Okay, so adding interest is a technique of taking present value and recalculating it into the future value. Okay, and it is worth knowing, although I know that most of you know it already, you can use two techniques here. Okay, there can be the so-called simple interest, And there can be compound interest. Okay, compound interest is especially interesting here. Of course, in a couple of minutes, I'm going to explain in detail what compound interest means. Okay, but you know, the simplest take on this is that by compounding, you include in calculating interest in the future periods interest that was made, that was earned in previous periods. Okay, so sort of you compound by, you know, by calculating interest on the interest earned previously. Okay, simple interest, on the other hand, does not include that. So in simple interest, the principal amount of your investment is not increased by interest earned in previous periods. Okay, and now what's interesting about the time value of money, and it's particularly often used in techniques of calculating value of different investments, value of different assets, and so on, is something that is opposite to adding interest, and this is called discounting. Okay, discounting, the opposite of interest. Okay, in discounting as a technique, you usually use compound interest. All right. So my proposition is that now we look at a sample, at some example to demonstrate how calculating simple interest and how calculating compound interest actually works. All right, so the example is going to be as follows. Let's assume that we have the present value that is being invested of 100 euros. Let's assume that the nominal or money rate of return is 5% annually. Right, and that we invest for the number of years equal to. Okay, so n is going to be the number of years for which we invest. Okay, in this example, we want to calculate the future value of the investment. Okay, assuming simple interest, so no compounding. Okay, and assuming that we compound interest every year. Okay, so how do we calculate the future value? How do we add interest? Okay, it's worth looking at things as they happen on the timeline. Okay, so here is now at the moment 0, 1 is going to be 1 year after, and then we have 2 years. All right, so the present value is 100. Okay, and over the period of 1 year, we will add interest of 5%. Okay, so I'm going to add 5% times 100. That, of course, equals to 5. Okay, so the future value of the investment after 1 year is going to equal 105 euros. Okay, if this is simple interest, so I don't use any compounding, that means that the 5 of the interest earned in the first year is not going to be added to the principal amount. Okay, so what that means is that after year 1, I will again add interest of 5% that will be applied to the principal of 100. That again is 5. All right, so the final future value after 2 years of this investment is going to be equal to 110. All right, this is simple interest. Okay, and if it doesn't look good for you, I mean, your intuition is absolutely right. In most cases, simple interest is used for short periods of time, if not specified otherwise, for periods shorter than 1 year. Okay, so typically For the second year, we would use compounding in real life, and this is something that we will do now. We will recalculate the same example, but using compound interest. Okay, the case is gonna look like this on the timeline. Okay, so again, those 2 years on the timeline, the present value equals to 100. Again, nothing changes in the first year. Okay, there's no interest for previous periods to be compounded. That's why interest is going to be the same in the first year. It's going to be 5% of 100, so 5. Okay, so the future value after the first period, the first year, is still going to be 105, irrespective of whether we compound interest or not, right? But in the second year, we are going to compound. This compounding means that in the second year, we will also add interest of 5%, but we will apply that interest to the number that is increased by the capitalized interest for the first year, which is of course 105. Okay, so when I now take 5% of 105, I will no longer have 5%, I'm going to have 5.25. Okay, where this additional 25 cents, of course, is 5% on the 5 of interest that was capitalized, right? So the future value of the investment after 2 years is going to equal 110.25 cents, okay, which is of course a greater amount than in the case of simple interest. Okay, so generally speaking, if we use compounding, we increase the financial performance of our investments because we calculate interest on interest previously earned. All right. And now in real life, we can have various different arrangements in the world of investing. Okay, we can have arrangements where the period for which the compounding period can be shorter, can be longer, but if it's not specified otherwise, for example, in an exam question, you will typically assume that up to periods of 1 year, you use simple interest. If you exceed the period of 1 year, you will apply compound interest. Okay, so the default, so to speak, compounding period is going to be 1 year. Okay, but we're going to take this example, take it a bit further to see what happens with the future value of the same investment with the same nominal rate of 5% if we shorten the compounding period. Say, for example, we assume that the bank or whoever is receiving our money and promising us the return of 5% will now compound interest not every year, but every 6 months. All right, so I'm going to draw another timeline. Okay, but now not with 2 periods, but with 4 compounding periods. Okay, moment 0, then 6 months after that, 12 months after that, okay, 1.5 year or 18 months, and finally 24 months, so 2 years later. Right, so now the present value, of course, is 100. All right, and I'm going to add interest, simple interest, but just for the first compounding period, which is 6 months in this case, not 1 year like above. Okay, so how much is this interest going to be? Well, it's still going to be 5%, but please notice that the 5% is the annual rate. So if I calculate interest for a period of time which is shorter than 1 year, I will need to adjust this interest to the fraction of time for which I calculate this. All right, so I'm going to notice that 6 months represents roughly half a year. Okay, so I'm going to multiply it by 1/2 or by half. Okay, I'm just calculating interest for the half of the year, and now the principal is 100. Okay, so clearly this interest is going to be 5% times 100 divided by 2. That's 5 divided by 2. That's 2.50. Okay, so after 6 months, the future value of the investment is going to be 102.50. Okay, and now I'm going to compound this 2.50, which essentially means that in the second half year of the first year, I'm going to calculate interest of 5%. Okay, it's for the second, just for 6 months. So again, times half of the year. Okay, and now not times 100, but times 102.50. Okay, so of course it's going to be slightly more than 2.50 because I will take 2.5% and multiply it and take it and calculate it not just based on 100 but also on the 250. Okay, of course I could use the calculator to solve this and do the calculation for the following four periods, but I think it makes sense to show you the formula that is typically used in such cases. Okay, so we need to add another variable, so to speak, to the equation. Okay, this variable is going to tell us how many times per year we capitalize or how many times per year we compound interest. Okay, this of course is going to be given by this number of 2 here. Okay, 2 means that I compound every 6 months. Okay, and I'm going to call this parameter m. Okay, so m is going to be number of compounding periods per year. All right, so if m equals to 1, that means we have annual compounding. Okay, just like in this case here. Yeah. Okay, then if m equals to 2, that means that we're going to have semi-annual compounding. Okay, if m equals to 12, okay, which can also be the case for certain instruments in the financial market, it means that we have got monthly compounding. Okay, so based on that, we can write a formula that is used for calculating the future value of the investment. Okay, so the future value is going to, irrespective of how often we capitalize, is always going to refer to this present value, which is 100 in our case. Okay, so I'm going to write that future value equals to the present value. And now I'm going to add this to this present value interest for as many compounding periods as I have. Okay, so now how many of those compounding periods do I have? Well, it depends on how many years I invest for. Like in this case, I had the n of 2 years in all those cases. Okay, I was investing for two years. Okay, and now the number of compounding periods in total is going to be the number of years multiplied by the number of compounding periods per every year. Like in this case, it is 4. Okay, 2 times 2. Okay, in this case, it is 2. 2 times 2 years times 1 compounding per year. Okay, I'm going to now multiply. I'm going to add interest for 1 compounding period first. Okay, so I multiply this present value by 1 times interest per every compounding period. Okay, so in the case I had 2 compounding periods per year, my interest was calculated as the interest rates divided by the number of compounding per year, which I called m. Okay, so it's going to be I divided by m, that's interest per one compounding period, okay, and I'm going to raise it to the power of the number of compounding periods in total, okay, which is, as I said earlier, given to me by n, which is the number of years, multiplied by m, which is the number of compounding periods per every year. Okay, a very useful formula, which I think is worth memorizing for the sake of your FM ACCA paper, but also for other reasons as well. Okay, and I want to take this formula, okay, and use it for the sake of calculating the future value of this investment in various variants, by changing the the number of the compounding periods per year. I'm going to use a spreadsheet for that. Okay, so here's the spreadsheet which I prepared to illustrate this compounding case. So I already inserted some of the values here to save us time. So we've got the present value of the investment, which is 100, the annual rate of return of 5%, the lifetime of the investment of 2 years. Okay, I also put down the formula for the future value. Okay, so what I'm going to do now is I'm going to insert this formula and then gradually change m, okay, the number of compounding periods within every year, and we'll see how the future value behaves. Okay, so I'm inserting the formula in accordance with what we can see. Okay, so present value of 100 multiplied by 1 plus the annual rate, and we're going to divide it by m. In this case, for annual compounding, m is equal to 1. Okay, and then I'm going to raise it to the power of 2 years multiplied by number of compounding periods in every year, which in this case is 1. Okay, there's one more thing that I want to do here. Namely, I want to copy this formula down so that we don't have to insert it every time. I'm going to do this by fixing the following formulas. Okay, I'm fixing C3, which is the present value. I'm also fixing C4, which is the annual rate, and I'm fixing C5, which is the number of years, because these are the values that will not change. Okay, so as we can see, the future value amounts to 100.25, which is exactly the same as what we calculated before. So there's quite a chance this is correct. Okay, and now I'm going to calculate the same future value, but for semi-annual compounding. Okay, semi-annual, which means I compound twice a year. Now when I copy the formula down, okay, let me round it down to cents. Okay, we see that we get slightly more, 110 euros and 38 cents. Okay, when I highlight the formula, we see that actually all the basic parameters, that is the present value, the rate, and the number of years didn't change. What did change is just the m representing the frequency of compounding. Okay, we can also calculate the increments, so the difference in the future value that we get between semi-annual compounding and annual compounding. Okay, we get 13 cents extra future value after doubling the frequency of compounding. Okay, let's see what happens when we do quarterly compounding. That means 4 times a year. Again, I copy the formula down. I get 110.45, which gives us the increment of 7 cents. Okay, then let's do the same for the monthly compounding. That is, we're compounding 12 times a year. Okay, copying down the formula, I get 110.49, which is 5 cents more. Okay, so as you can see, the increments are getting smaller and smaller and smaller. So every time I increase the frequency of compounding, I get some more future value, but but the increase is less and less and less every time, which means that probably there's a boundary somewhere. Okay, so you cannot infinitely increase the financial performance of an investment by just increasing the frequency of compounding. Okay, so the last iteration that we'll do here is the daily compounding. So 365 times a year I'm doing this. Okay, and I get 110.52 cents, which gives me the increment of just 2 cents. All right, can I continue this example? Well, of course I can. I can do, compounding every minute, every second, every, even shorter amount of time, but there's no need to do that because in fact, we can calculate, there is a formula that shows the boundary to compounding, okay? Namely, if we increase the amount of compounding periods within every year to infinity, we get something that is referred to as continuous compounding. Okay, continuous compounding. Okay, so if I was to illustrate that graphically, I would draw something like this. Okay, this again is our timeline. We've got the lifetime of the investment of 2 years. Okay, and I'm going to compound, I'm going to add interest initially to the starting value of 100 of a very small portion of the rate of 5%. I'm going to add the interest, okay, and compound again and compound again and again and so on and so forth. And I will do it in such a way that the number of the compounding periods within this year is going to be infinity. Okay, so it's something like taking this formula and transforming it into present value multiplied by 1 plus the infinitely small fraction of I, okay, and raised to the power of 2 years multiplied by infinity. Well, of course, it's something that is very difficult to be calculated because, well, I don't know how to raise numbers to the power of infinity. And also, in particular, I don't know how to divide by infinity. Luckily, it can be proven that this formula can be transformed into something much more user-friendly. Okay, so the more user-friendly version looks like this. Okay, the future value equals to present value multiplied by the mathematical constant of E, and this E is raised to the power of n, which is number of years, and I, which is the annual rate. Okay, looking much more simple. Okay, and this simplicity of this formula actually is one of the, if not the only, reason why continuous compounding is very often used in various financial formulas. Okay, like for example, if you analyzed Black and Scholes formula for calculating value of options, for example, the continuous compounding is used. Okay, now of course this requires some explanation. Okay, what is this E? Well, it's a mathematical constant, as I said. Okay, first of all, it's the basis of the natural logarithm. Okay, so if you have something like natural logarithm of, I don't know, of a number x, okay, in fact, it means that it's a logarithm that has the base of E. Okay, this is the number. Of course, it's not telling us a lot. Similarly, like, mentioning that this E is the so-called Euler's number. Okay, it's much simpler just to mention that this number has a value of 2.7183. Okay, and there's of course many more digits. Okay, so if you have no access to a scientific calculator, or you have no access to Excel or other tool that gives you this E automatically, you can simply use 2.7183 and so on, and you will get a very sensible answer. All right, so let's take this formula now. Let's go back to Excel and let's recalculate it for our case where the present value is 100, I is 5, and n is 2. Okay, so I'm going to use the Excel formula for the exponential function, so e being raised to something. Okay, this function looks like this in the English version of Excel. Okay, so if I put down exp and open a bracket, it means that I'm raising something, whatever is in the bracket, to the power. I'm raising e to the power of whatever is in this bracket. Okay, so I'm gonna take the present value of 100 and multiply it by e raised to the power of 2 years times the annual rate of 5%. Okay, and when I solve the formula, I get almost exactly the same number as for daily compounding. Okay, of course, this is not the same number. There is a difference. To see this difference, we have to look at some, more decimal places in the fraction. As you can see, in the third decimal place, there's a difference. Okay, the number for continuous compounding is slightly higher. Okay, but generally, what it all means, it means that for the rate of return of 5% annually, okay, you cannot get more with this rate from an investment of 100 than getting 110 and 52 cents by simply increasing the frequency of compounding. If an investor is not happy with these numbers, it means that they will not be able to get anything more but just increasing the compounding frequency. Okay, what they have to do if they want to make more return than 110.52 is they need to look for a different investment that will promise a higher return than just 5%. Okay, and luckily in the financial markets there are investments that come in various shapes and sizes, promising different returns. But, well, of course, life is not so simple. It's not just that we pick the investment that promises the higher return to make the most. Unfortunately, there's also a risk component to it. Okay, so in finance, we often, or maybe not often, we all time think about investments in the context of their riskiness. Okay, there's a relationship between risk and return in finance, and of course there's going to be a separate video about this risk versus return paradigm in finance and its very serious consequences to financial managements.